Thank you very much, Mr. Chairman. Today we focus on anti-poverty and family support provisions of the tax code. It's important to have a conversation about existing provisions, what has worked in the past and what more can be done. If there is one message to distill today, it is that if America is serious about reducing poverty and supporting families, work works. Without work, there is no chance society will achieve either aim. Successes here will be grounded in those from the past. In 1996, I joined a bipartisan bicameral group of colleagues, including some in this room today, in voting to pass the Welfare Reform Bill. In the decades since, this landmark legislation reforms have led to undeniable intergenerational success. One of the welfare reform's key changes was to replace an ineffective cash handout system with one focused on incentivizing work, job training, and self-sufficiency. One of our witnesses, Bruce Meyer, has written extensively about the lessons of welfare reform and parallels for today. Another, Grant Collins, has extensive practical experience with pro-work, anti-poverty interventions. The decisive transformational results of welfare reform speak for themselves, including marked increases in work and earnings for single mothers, almost doubling for some cohorts. Sharp poverty reductions, with consumption poverty declining by more than 70% since 1996 to just 3.7% in 2018, and broad declines in benefit dependence, including a five-fold reduction in those needing temporary assistance. As President Biden, who as a senator voted in favor of this welfare reform, said at that time, "I think everyone here believes that work should be the premise of our welfare system." Not surprisingly, recent polling from May shows that nearly 2/3 of Americans support work requirements for recipients of government benefits. Welfare reform proves that we can exercise common sense and be compassionate and fiscally responsible all at the same time. These lessons were applied, for example, when Republicans first proposed the child tax credit in the Contract with America, and were retained when they enacted the credit in 1997, expanded it in 2001 and in 2009, and doubled it in the momentous 2017 tax reform bill. In 2017, Republicans also doubled the standard deduction, lowered tax rates for the hundreds of millions of lower and middle income class Americans, and stretched those lower rates further through expanded tax brackets. All of these changes put money back into the pockets of working families, and it is no surprise that after the bill's enactment, Americans' disposable personal income jumped nearly 87% in the first quarter of 2018 over the last quarter of 2017. I look forward to hearing more from today's witnesses on the key lessons learned from these successes in reducing poverty and supporting working families. In recent years, some have seemed to have forgotten what previously worked and have pushed for changes to government assistance that appear to be generous, but in the end will certainly not solve poverty or even just child poverty. The direct costs for these ideas are enormous. Indirectly, data show that they actually become an impediment to intergenerational growth and upward mobility. Just this past February, for example, results of a cash allowance program being piloted in Spain have arrived. The program has already had sizable and adverse employment effects, with aid recipients being 20% less likely to work and families receiving benefits 14% less likely to have any family member working. As another example, in October 2022, the nonpartisan Joint JCT evaluated Democrats' partisan temporary changes to the child tax credit, and they reached two critical conclusions. First, they estimated a staggering cost to continue them, more than $1.2 trillion in the budget window, to say nothing of years beyond. Second, they confirmed that the provision disincentivizes work with a dynamic cost, estimating factoring in work and growth that approached $1.4 trillion, more than its headline estimate. Evidence is sometimes warped to manufacture contrary conclusions. But Professor Myers and Mr. Collins will tell us that an honest accounting of the data is clear. Unconditional direct transfer policies simply do not achieve their aim of actually reducing poverty and dependency, even if they are called a tax credit. There are many thoughtful, compassionate, and prudent ideas worth considering to ensure that our social safety net is strong for those who need it the most. What makes the most sense is to undo the good that has what makes no sense is to undo the good that has already been done through harmful policies, whether in the name of equity, morality, or anything else. Progress requires building upon yesterday's gains, not tearing them down. Thank you, Mr. Chairman.